In 2008, people lost jobs, homes, and savings overnight. In 2026, people lose something quieter: margin. The space between income and survival disappears so slowly that you don't notice until one small problem suddenly feels dangerous. In 2008, the warning signs were loud and impossible to ignore. Layoffs made the news banks failed on camera, and entire neighborhoods changed almost overnight. But 2026 is different because this time the pressure doesn't arrive as a shock, it arrives as a subtraction. You're still working, your job still exists, your paycheck still comes in on time. And yet, month after month, something feels wrong. The space between what you earn and what life costs is shrinking, quietly, consistently, until even small expenses begin to feel risky. This is why 2026 feels poorer than 2008 for so many Americans, even without a visible crisis. Back then, loss was obvious and collective. Now it's private and incremental. A raise that should have helped barely registers. A bill that used to be manageable now demands planning. A routine repair suddenly requires decision. And because nothing dramatic breaks, people assume the problem is personal, that they mismanaged something, that they should be doing better, when in reality the system itself has changed how pressure is distributed. In 2026, the economy doesn't collapse downward. It compresses inward. Costs rise not in one category but across many at once, and wages fail to keep pace where it matters most. The result isn't panic, it's constant calculation. Every purchase is measured, every month is tighter than the last, and this slow compression changes behavior in subtle but profound ways. People stop thinking years ahead and start thinking in billing cycles. They delay maintenance, delay healthcare, delay plans, not because they're careless, but because margin has become the rarest resource in modern American life. In 2008, people could point to a single event and say, that's when things fell apart. In 2026, there is no single moment, just a growing sense that effort no longer produces stability the way it used to. This is what makes this period so disorienting. The economy appears functional from the outside, yet inside millions of households are quietly losing flexibility, resilience, and confidence. And when margin disappears, everything else becomes fragile. One unexpected expense, one insurance change, one missed week of work. Suddenly, a normal life feels unaffordable. That is the real story of 2026. Not collapse, but compression. And once you see it clearly, you start to understand why so many people feel poorer now than they did during the last real crisis, even though they never stopped working. In 2026, the biggest lie people are told is that a raise means progress, because on paper, wages did go up. 3% here, 4% there. But the moment that paycheck lands, reality removes the illusion almost instantly. Real wages are not what your employer pays you. Real wages are what's left after rent, insurance, utilities, food, and transportation take their cut. And that cut has been growing faster than pay for years now. A household earning $72,000 a year might see an extra $2,000 before taxes from a raise. But in the same 12 months, rent rises by $150 a month. Auto insurance jumps another $98, groceries quietly cost $60 more per week, and utilities spike with seasonal rate increases. Suddenly, that raise is gone before March ends. This is why 2026 feels poorer than 2008, even without layoffs. The erosion is constant, spread out, and disguised as normal. Inflation doesn't need to explode to hurt you. It just needs to outpace wage growth in the categories you cannot avoid, and those categories are exactly where the pressure is highest. Housing alone absorbs a larger share of post-tax income than it did a decade ago for renters, and new buyers alike, while healthcare premiums and deductibles rise in ways most families don't feel until they try to use them. Even groceries, the most basic metric of living standards, tell the story clearly. People aren't buying more. They're buying smaller quantities, cheaper brands, fewer fresh items. Not because they want to, but because budgets no longer stretch. And the psychological damage is just as important as the financial one, because when someone works full-time and still feels behind, trust in effort itself starts to break down. In 2008, the loss was sudden and visible. Jobs disappeared, homes went underwater, and people knew exactly what had gone wrong. In 2026, the damage is quieter, harder to explain, and therefore harder to fight. You still go to work, still pay bills, still appear fine from the outside, but internally, every month feels tighter than the last. Every unexpected expense feels dangerous, and every small decision carries weight. Parents delay dentist visits, not because they're irresponsible, but because that $400 bill collides with insurance renewals and school costs in the same month. Cars run longer without maintenance. Subscriptions quietly replace savings. Vacations turn into stay-home plans, not as a choice, but as a default. This is what makes the year feel emotionally poorer than 2008. Not mass panic, but constant calculation. And when wage growth fails to outpace real-world costs, the middle class doesn't collapse dramatically. it compresses. The distance between doing okay and one problem away becomes so small that people stop planning years ahead and start thinking only in pay cycles. That shift from future thinking to survival thinking is the real economic signal of 2026, and it's happening while headlines still say the economy is strong. The truth is simpler and harsher. When raises can't buy stability, employment stops being a shield, and that's when a working economy starts to feel poor. By 2026, the squeeze becomes unavoidable, not because of one catastrophic bill, but because of how ordinary expenses now stack together in ways they never used to, turning daily life into a math problem with no clean solution. Housing is the anchor weight. Whether you rent or own shelter now consumes a larger share of take-home pay than it did for most Americans a decade ago. And the increase rarely arrives as a single shock. It comes through renewal notices, property tax adjustments passed onto tenants, HOA fees, insurance, escrow changes, and higher maintenance costs that don't wait for a good month. A renter paying $2,400 in 2021 finds the same unit at $1,850 in 2026, while a homeowner with a fixed mortgage still watches monthly costs rise as insurance premiums and local taxes climb quietly in the background. Utilities follow the same pattern. Electricity, gas, and water rates increase through layered adjustments that most people don't notice until seasonal extremes hit, when a winter heating bill or summer cooling bill arrives hundreds of dollars higher than expected, forcing families to ration comfort inside their own homes. Then there's insurance, auto, health, home, the most underestimated drain of all, because premiums rise whether you use them or not. Deductibles rise when you do. And many households discover too late that their coverage now protects the insurer's balance sheet more than their own finances. Groceries complete the picture, not through dramatic price tags, but through shrinkage and substitution. Packages get smaller, fresh items get replaced with processed ones, brand loyalty disappears, and weekly shopping becomes a series of trade-offs instead of choices. Add to this the quiet explosion of service fees, banking charges, delivery surcharges, subscription renewals, convenience costs baked into everything from parking to payments, and the modern household finds itself paying more simply to participate in normal life. None of these categories alone looks like a crisis, which is why they're so dangerous together. When rent takes an extra $300, insurance another $120, utilities $80, groceries $250, and fees quietly absorb $100 more per month. The combined effect isn't discomfort, it's displacement of everything that used to create stability: savings, repairs, education, and rest. In 2008, people could point to a single failure and say, that's where it broke. In 2026, nothing breaks cleanly. Instead, affordability dissolves. People stay housed, insured, and fed, but only by sacrificing resilience. Emergency funds vanish first. Preventative health care disappears next. Then hobbies, then social life, then hope. The cost of living doesn't announce itself with sirens. It erodes silently, month by month, until households realize they're no longer living inside a budget, but inside a set of constraints they didn't choose. And this is the moment when a functioning economy begins to feel hostile. Not because it stops providing goods, but because access to normal life becomes conditional on constant financial vigilance. That is the real cost story of 2026. Not inflation as a headline, but affordability as a daily negotiation that never seems to end. By the time 2026 settles in, most American households are no longer using credit as a convenience. They are using it as a stabilizer, and that single shift explains why this period feels so fragile, even while employment numbers look healthy. Credit cards, buy now, pay later plans, longer auto loans, and revolving lines of credit are no longer optional tools. They have quietly replaced savings as the first line of defense against normal life. A car repair, a medical bill, a utility spike, or even groceries at the end of the month increasingly goes on to plastic. Not because people are reckless, but because the margin between income and essential expenses has already been consumed. Credit card balances climb not in moments of indulgence, but in moments of necessity, and interest rates quietly turn those moments into long-term obligations. A family that carries a $6,000 balance at a high interest rate isn't paying for one bad decision. They are paying for a series of small gaps that never closed. And by 2026, those gaps are common across middle-income households. The minimum payment becomes the new normal, and the minimum payment itself becomes a fixed monthly expense that crowds out future flexibility. What makes this cycle especially dangerous is that it doesn't feel like a crisis at first. Credit works smoothly, payments process on time, life continues. The damage hides in compounding interest that doesn't announce itself until months or years later. Buy now, pay later systems accelerate this illusion by turning single purchases into 4 smaller ones, lowering the immediate pain while stacking future obligations on top of each other, so that by the time a household reviews its finances, several months of future income is already spoken for. Auto loans stretch longer with higher monthly payments spread over more years, locking families into transportation costs that can't be reduced without selling the vehicle itself. an option most people don't have once they rely on it for work. At the same time, savings rates erode quietly, not through a dramatic withdrawal, but through attrition. Emergency funds get tapped for a repair, then fail to get replenished, then disappear entirely, leaving credit as the only remaining buffer. This is the critical difference between discomfort and danger. Savings absorb shocks and end, debt absorbs shocks and multiplies. In 2008, the failure was visible and systemic. Banks failed, markets collapsed, jobs vanished, and while the pain was severe, the cause was identifiable. In 2026, the vulnerability is personal and distributed. There is no single institution to blame, no obvious moment of collapse, only millions of households carrying fragile balance sheets that depend on everything going right at once. And because employment continues, people blame themselves instead of the system, assuming their stress is personal rather than structural. This internalization deepens the damage as households take on more hours, more side work, more exhaustion to stay afloat, trading health and time for temporary financial relief. The feedback loop is brutal. Debt payments reduce disposable income, reduced income increases reliance on credit, and rising balances increase interest costs, tightening the loop with each cycle. Even a modest disruption, a few weeks of reduced hours, a deductible reset, a rent increase, can tip a household from stable to strained, not because the event is large, but because the system has no slack left. Credit, once marketed as empowerment, becomes an invisible constraint, shaping decisions long before any formal default occurs. Families delay moves, delay children, delay education, delay healthcare, not because they can't imagine a future, but because their present is already pre-allocated. This is why 2026 is more precarious than it looks. The economy can continue functioning while resilience collapses underneath it. Stores stay stocked, jobs remain posted, and services keep running, but the financial architecture of ordinary life shifts from ownership and savings toward access and monthly obligation. When a society moves from saving first and borrowing second to borrowing first and hoping later, stability becomes conditional, and conditional stability always fails quietly before it fails loudly. By the time headlines catch up, the damage is already embedded in household balance sheets, and recovery becomes harder not because people won't work, but because they've already committed tomorrow's income to yesterday's costs. That is the real risk of 2026. Not a sudden crash, but a slow conversion of financial stress into permanent vulnerability, carried one minimum payment at a time. By the end of 2026, the most important thing to understand is that nothing failed in the dramatic way people expect. The system didn't crash, stores didn't empty, and jobs didn't vanish overnight. Yet for millions of Americans, stability quietly slipped out of reach, and the signs were there long before anyone named it. You can see this shift not in headlines, but in small indicators that rarely make the news. Households tracking expenses weekly instead of monthly, emergency savings shrinking below one paycheck, credit balances rising even among fully employed workers, and more people delaying decisions that used to feel routine. Moving, changing jobs, starting families, fixing health issues, because the margin for error is gone. These are the signals that define a poorer feeling year, not GDP growth or stock indexes. When people stop thinking in years and start thinking in billing cycles, the economy may still be functioning, but confidence has already been lost. And once confidence disappears, behavior changes. Spending becomes defensive, risk-taking vanishes, and even modest price increases feel threatening because there is no buffer left to absorb them. This is why 2026 doesn't feel like 2008. It feels quieter, lonelier, and harder to explain because everyone assumes they are the only one struggling. The truth is structural, not personal. When wages fail to outrun essentials, when savings are replaced by debt, and when normal life requires constant financial vigilance, the middle class doesn't collapse. It compresses, and compressed systems eventually crack. The most dangerous part of this period is not fear, but normalization. People accept that being permanently tired, anxious, and financially stretched is just how modern life works, and that acceptance delays correction far longer than panic ever could. Yet even in this environment, awareness still matters. Watching a few simple metrics, real wage growth, housing costs as a share of income, household savings rates, and consumer credit balances, tells a clearer story than any election cycle or market rally. And on a personal level, the path forward isn't about extreme solutions or dramatic exits, but about regaining margin wherever possible, rebuilding even a small cash buffer, auditing recurring expenses with brutal honesty, resisting the quiet creep of obligations, and understanding that stability today is less about how much you earn and more about how much flexibility you preserve. This isn't advice meant to inspire fear. It's meant to restore clarity. Because once people recognize that what they're feeling is shared, not isolated, the narrative changes. Stress becomes information, awareness becomes leverage, and conversations shift from shame to strategy. If this video felt uncomfortably familiar, that's not a failure. It's recognition. And recognition is always the first step before things change. If you want to understand what's happening beneath the surface of the U.S. economy, how these pressures connect, and what to watch before they show up on the evening news, subscribe, not for panic, but for perspective. And in the comments, say one thing that costs more in your life now than it did just a few years ago. Not to complain, but to document what this moment actually feels like while it's still happening.